So much for some of those high-flying stocks. I'm joined by Real Money contributor Doug Kass, who's looking at the FANG stocks. Doug, nice to see you.
Hey, Rhonda.
So some of these stocks that have been in the news and been flying high until recently, you're not expecting much from in the future. That's Tesla and some FANG names.
Actually, I'm pretty negative about this sector, or against actually this acronym. I call it T-FANGs. The T is silent for Tesla. Jimmy invented the term FANG. I think it's not very different this time around. It's this market-leading group resembles, to me, a sequel of the dot-com boom in the late 1990s, and as well as the top of the market back in 2007, 2008 for the mortgage lenders, the service providers and originators.
Doug, let me ask you before we get into the flashback part of what you just said. Some of these companies, unlike the first dot-com boom, actually have things like earnings and revenues, these FANG stocks. So isn't it a little bit different?
Sure, it's always different in complexion. While they do have earnings and they are trading at similarly inflated and elevated multiples, there are questions about the sustainability or the ability to attain a certain level of profitability. And we saw on Friday with Tableau Software and LinkedIn questions regarding the long-term secular growth prospects for two important social media securities members. And I think that lit up some concerns. Look, Amazon's earnings expectations have been steadily growing while the stock has steadily been advancing. The same applies to Netflix and to Tesla, three stocks that I'm short.
So, Doug, why do you broaden it out and say it's not just a story about some of these companies that perhaps got overvalued? Why is it a bigger story for the market overall?
I think it's a bigger story, Rhonda, because there's been sort of seeds of malinvestment which emanate from zero interest rates and massive infusions of liquidity into our economic system. And that was manifested in the proliferation of these private equity, what they call unicorn valuations companies that are not yet public with over $1 billion market capitalizations. They're also reflected in social media stocks' elevated price earnings multiples, to me, which sort of approached the level in the late 1990s. We've had an experience where these coders, which form, are the employees that form the basis of the social media stocks, have become almost rock stars. We've had a steady and ready acceptance of non-GAAP accounting that excluded stock-based compensation, another feature of this cycle.
Doug, I want to ask you, if things are as bad as you say, potentially then, does that tell us all the selling we've seen on Wall Street so far is nowhere over?
Well, that's the $65 billion question. We never know for sure, but we do know when growth expectations begin to be markedly reduced, as was the case at LinkedIn and Tableau Software, really rapidly growing members of the T-FANG cabal, their multiples, the price earnings multiples, are so inflated that it's very hard to figure out where the bottom is. The other thing, Rhonda, is we've seen such narrowing in market leadership over the last 12 months, something I've been highlighting on Real Money and Real Money Pro. We first saw the major market leader, Apple, begin to perform poorly, both on an absolute and relative basis about a year ago when I reshorted the stock, and now all the T-FANG stocks are going lower. What happens is this has become a very crowded trade. So when all investors and traders try to run for the exits, that door becomes smaller and smaller because there's so much stock to sell.
Real Money's Doug Kass. Great to talk to you, Doug. Thank you.
Thanks, Rhonda.
I'm Rhonda Schaffler for The Street.